The number one reason stock market's top. Hi, it's Charlie giving you Saturday's video. I'm actually currently away on a holiday. I've recorded this almost a week ago, but wanted to get a video out while I was away. But this is a beautiful chart here of the S&P 500. As you can see, we've got price, you've got all the main moving averages all stacked up in the right order. That's a weekly chart there. So it's a very good looking chart overall in that regard. But why do stock markets, or what is the number one reason that stock markets top? Now, we can talk about the fundamentals and what sets them off to an extent. But the number one reason that stock markets top is because there's no more buyers. That's it. There are no more buyers. And so if you look at any major market cycle highs that we've had over the decades, when we've had those major market cycle highs, generally there's been a fair bit of euphoria and disbelief that the market would be coming down, because you need to get to that point where there's almost no one left to buy in order for the market to come down. If you've got a wall of worry whereby every time you just have the beginnings of what looks like might be a bit of a set-off, and then the market then just reverses again, then that tells you there's plenty of fear in the market. And all the time there's fear in the market, well, that means that there's always going to be those buyers sat on the sidelines who are going to be throwing in the towel at some point, saying, oh yeah, I need to buy. Or it could just be that every time the market looks like maybe it's going to come off, portfolio managers who might be doing hedging just release their hedges and then get long again, or add to their longs. So that's essentially it. So you have to get to that point whereby people aren't hedged, or that people aren't bearish. When I say people, the majority aren't bearish and the majority are bullish, because if the majority are bullish, then they're already heavily invested and already fully invested maybe. And if they're fully invested, when the market starts coming down, they've got nothing left to keep adding in. And that's when you get the makings of market highs. And then you can talk about the fundamentals and what drives it, and as far as what particular event might drive any particular correction or pullback, or meaningful pullback within a market. But essentially, it's when there's no new buyers left to buy. How can we actually go about finding that information? Well, you can look at sentiment reports. You can look at, certainly for the US, you can look at the AAII reports, which is the Association of Individual Investors. You can look at things like put-call ratios. You can look at even the COT reports and see, how heavily invested fund managers are as well. Are they exposed? Are they overly I say overly invested, but relative to past, have they got themselves overly exposed as well? So you can usually, and you can look at what obviously retail trader sentiment is doing as well. But unfortunately with retail, certainly if you look at CFD accounts, then retail are usually doing the opposite to what the markets are actually doing. So retail, if the market's going high, then retail are usually shorting. Yeah, I've literally just looked at a sentiment indicator for retail right now, and it's showing that 71% of retail traders are short. That's on CFDs, short-term trader accounts. So not talking about investors now, but that's typical of what short-term traders do, retail traders do. They tend to, as the market goes up, they want to short it, and as the market goes down, they want to buy it. So, but in the main, we're talking about the investors, the people who are looking to be invested in the market. Is when they're all net long and are massively exposed, because there's very few bears out there. Those are the times that we want to be wary. And so whether we're there at the moment, I'd suspect not, because as we've seen during these pullbacks, as soon as we've seen these minor pullbacks, things like the VIX, the volatility index, have shot right up so quickly. And so the market is rising on a wall of worry, as I've said before, and so don't get me wrong. At some point, like any market, there will be a pullback, but historically, usually you're getting to a point where there's an imbalance, and you've got more and more people and investors who are long. It creates the recipe that if the market starts coming down, then if they then start to sell, then it can create that crescendo of or wave of selling that can start to accumulate. So we're not at any major extremes at the moment, but we have got obviously a lot of a reasonable amount of euphoria, but not massively, because of, like I've said, we only have a couple of down days and the market gets fearful. What you want is a situation where you have a couple of down days and everyone's just sort of saying, oh no, just buy the dip type thing. So and when the more and more people are like that, then we're getting close to a high. There we go. There's a little bit of food for thought for you there for this weekend. Take care for now. I'll see you in a week's time.